Hi everyone, and welcome to the webinar about fair value hierarchy that we are preparing during this day. And with me, my name is Francisco Jimenez. I'm leading a department in KPMG that is called KPMG Financial Instrument, where we are in charge of valuations. And with me is Zhong and Andrew McCarthy, that is effectively working both as associate director and manager in the team. We will review what is the fair value hierarchy. That is a topic that most of us, we don't take a lot of attention during the life because effectively classifying instruments between level 1, level 2, and level 3 is not the most difficult piece, or is not the most attention piece because it's not affecting the balance sheet or the income statement, but obviously is impacting your financial statements and is in the different ones. Regulators during these days, and Ni and Andy will talk on it in a moment, they are focusing more and more on that topic. And just to be clear, is not a very cut clean classification, and it's important to understand and to make sure that you're analyzing the product in itself one by one. And with that, I will leave you with Uni.
Yep, thank you very much, Fran, and good morning, everyone. Thank you for joining us today. So I'll be walking you through the first part of our session, focusing on our independent observations and the regulatory perspective on leveling. We'll begin by comparisons between our classifications with those of our clients, then explore our alignment with regulators' view of the applications of level 1, 2, and 3. Finally, we'll examine some trends we observed in equity and debt securities based on our analysis. So moving on to the next slide. So in one of our largest client samples, we found that 96.55% of our independent classifications aligned with those reported by the entity. Even though the percentage seems very high, we are still seeing roughly 5% of the population that could potentially be material, with our classification disagreeing with the entity. We believe this reinforces the value of independent oversight in the classification process. And as independent valuation specialists, we commonly receive questions and challenges with regards to leveling. This slide kind of on the left-hand side breaks down roughly how our independent classifications vary across 5 key asset types. So you can see in here, equities and G7 sovereign debts are typically highly liquid, and we saw 96% and 90% of them classified as level 1 respectively, which is expected given the availability of quoted prices and active trading. Even though listed derivatives are also traded on exchange, only 51% are classified as level 1 by us. This is due to lower observed liquidity in some instruments, for example, out-of-the-money options, with scarce trading around measurement dates, which could push them into level 2. And only 53% of sovereign debts in other countries are assigned level 1 by us, largely due to wider bid-ask spreads and less active trading. Corporate debt had the largest gap, with 34% classified as level 1 and the rest falling under level 2, given lack of observable market prices and reliance on evaluated pricing. This is one of the asset types where we saw a lot of discrepancies between our classification and the entities in general. And commonly, this is due to entities utilizing a blanket approach for debt securities and have everything classified as level 2, while we investigate certain parameters. So when assessing leveling for securities, we focus on granular asset-specific assessments rather than broad assumptions during application. So moving on to the regulatory perspective. I'm sure the level 1 and 2 classifications are clear for everyone. So for level 1, think of a listed equity like Apple shares on NASDAQ exchange. The price is directly observable in an active market with no need for adjustments, traded every day with large volumes, which signals the gold standard for level 1 inputs. For level 2, an example can be a corporate bond from a smaller issuer that might not trade frequently. And if we have observable inputs like prices of similar bonds, yield curves, or credit spreads, it can be classified as level 2. A few things to decide here are what frequency of trading should be classified as active. And if a bond is traded over the counter with its prices modeled by pricing services based on broker quotes or comparable traits, it is directly a level 2. Level 3 is more complex. The key consideration here is the usage of unobservable inputs, as well as the consideration for significance. A typical example of level 3 would be a modeled price for the equity tranche of a CLO, as the valuation is based on internal models like discounted cash flows. Inputs including but not limited to yields, cash flow expectations, call assumptions, etc., being not only unobservable but also significant. The security would easily fall under level 3. However, unobservable inputs don't always signal level 3. With significant test in place, we can see sometimes the impact of these inputs are trivial to the value, which can shift the classification to level 2 instead. So on the next slide, you can see that we've done a few analysis based on actual client portfolios, which provides insights into how fair value hierarchy are applied in practice. Starting with equities, we observe a clear inverse relationship between trading volume and bid-ask spreads. This means that higher trading volumes tend to be associated with tighter spreads, indicating better liquidity and more reliable pricing. This relationship is crucial in guiding our threshold decisions for level 1 classification. For debt instruments, our data reveals distinct patterns. G7 and G12 sovereign bonds are predominantly classified as level 1, reflecting their active trading and transparent pricing. Municipals and corporate bonds, however, showed a much higher proportion in level 2, and this suggests that while market data exists, it's not as directly observable or consistent. And finally, just like many of our clients, we work with a lot of pricing services, and among all bond prices we receive from our vendors, securitized non-investment grade debts stands out with the highest price dispersion, indicating greater valuation uncertainty and a tendency towards level 3 classification. In contrast, investment grade sovereign and corporate debts show the lowest dispersion, aligning with level 1 and level 2 characteristics. This analysis underscores the importance of data-driven classification and highlights how liquidity, pricing dispersion, and market activity directly influence leveling decisions. And with this, I'll now hand over to Andy, who will take us through the challenges and our insights around the topic.
Thanks a lot, Nee. Hi everyone, my name's Andrew McCarthy and I'll be taking you through key challenges and our insights on leveling. Before I kick that off, I'll just mention I saw a couple of questions come in regarding the slides and they will be made available after the presentation. Okay, starting with firstly, what constitutes an active market? So per the standards for IFRS 13, level 1 classifications are essentially quoted prices in active markets. However, this standard doesn't exactly give a definition of what constitutes active. So, for example, here we've given a scenario where you could have a share in a small cap company that's listed on various exchanges and could be classified as level 1 by some entity. However, looking into this, you could see that it only trades a couple of times per week or a couple of times per month and with very low traded volumes each time. It could have a very wide bid-ask spread, and therefore this quoted price would be based on limited trading activity and not in a deep liquid market. In this kind of a scenario, we would argue that it is a quoted price, but not from an active market, and therefore it doesn't meet the definition of a level 1 security. And so again, yeah, this is where the kind of subjectivity around active can come into play. But some of the insights we do have are ensuring that you have a consistent and structured framework and consistent documentation around what does constitute active, whether that involves thresholds of traded volumes, of daily trades, of bid-ask spreads, and consistently and continuously reviewing markets and traded volumes and thresholds to ensure that you're up to date with the market, and these is a recommendation here. Next of all, the IFRS 13 once again would always recommend using maximizing the use of level 1 inputs. So there are again scenarios where this is not always the easiest thing to do. So for example, we've given a US T-bill here, can often be classified as level 2 by some of our clients. This is usually because, as Nee mentioned, we can use pricing vendors, which would rely on evaluated prices. All these evaluated prices would be based on observable market inputs, which would meet the definition of a level 2 classification. However, we know from experience that US T-bills are some of the most actively traded securities across the world, and they always have quoted prices in very liquid and transparent markets. For this reason, we would always classify, or I think it was 90%-ish of the time in the previous slides we saw, we would classify these kind of positions as level 1, whereas a lot of our clients would sometimes classify them as level 2. Our insights again on this would be, one thing that kind of leads to this issue would be clients adopting a family approach. So that would be, say, classifying all equities as level 1, all debt as level 2, etc. It can be a bit more granular than that, but in summary, that's what we can see. And so this is kind of something we would try to recommend clients not to do. It's we tend to look at instruments on a securities by security basis. And if a family approach is being taken, trying to make the families or classifications as granular as possible can help with this, as well as applying consistent framework to fair value classifications, whether that's bid-ask spreads or trading volumes, as I mentioned previously, and having a good governance structure in place for fair value compliance and reviewing these practices as well is a good procedure. We've also noticed a big increase in regulatory scrutiny over the past few years. The IASB and the FASB in particular have intensified their focus on fair value practices. So we've noticed stricter disclosure standards under ASC 820 and IFRS 13, which both require transparent input and methodology reporting, as well as greater detail in valuation disclosures. So an example we've given for this scenario is, like, say, a non-complex level 2 security, like a corporate bond. These must meet SEC Rule 2A5, which requires thorough documentation, strong governance, and ongoing valuation oversight even. So again, asset managers may see a position like this and think it's a corporate bond and it's non-complex and straightforward, but all the documentation of this needs to be all inputs and assumptions need to be documented under SEC Rule 2A5 in order to meet compliance with this. And yeah, again, our insights here would be to have strong governance and oversight over these, to have very strong documentation procedures in place, and to have informed decisions made on this, whether that's increased training on fair value hierarchy or fair value valuation process. Next of all, we have significance and application of level 3 inputs. I think, as Nee mentioned previously, per the standard, per IFRS 13, for something to be classified as level 3, it needs to have not just unobservable inputs, but significant unobservable inputs. And once again, just like an active market, the standards don't define what it means to be significant here. So again, there is significant professional judgment on what it is to be significant. And the example here we've given is, say we're valuing an option. Volatility is always a very key input in option valuation, whether it's Black-Scholes or Monte Carlo simulation, it's always a very important part of it. Now, if the option you're trying to value is on, say, a less liquid index, for example, in this situation, implied volatility might not be available because there's limited trading on this. So therefore, historical volatility may be the only input possible regarding volatility. And as we've noticed, if we're considering historical volatility, this is an entirely unobservable input because we have no idea what look-back period is sufficient. In this example here, we've given different volatility measures of an example index for a 1 month look back, 3 month look back, 6 month look back, a 12 month look back. And these volatility figures are ranging from 9.6% to 10.4%. And using any of these as an input in our models would result in market values ranging from 2960 to 3050 in this example. So having done this, what we would generally consider if we're using this unobservable input, we would consider the uncertainty in the unobservable input, and we consider the impact this has on the market value. Generally, what we do is we consider the impact that a reasonable shift of the unobservable input has on the market value, generally using 5% as a threshold. If the unobservable input has an impact of over 5%, we would consider that to be significant. But again, that's subjective, and what we would recommend here is keeping documentation consistent for this and transparent, so that, again, you can justify your claims that something is or isn't significant. Next of all, considering complex valuation models, this can lead to some issues regarding level 2 versus level 3 securities. This kind of example we've given is, say, a derivative can often be valued using a model that is maybe overly simple or not quite complex enough to capture the proper model that should be used for it. So if this is the case, quite often two counterparties would enter a derivative. One would value it using a simple model, another would value it using a much more complex model that captured it accurately. And we could often see these valuations aligning, even though there's not a proper level of kind of understanding behind what is going on in this position and what are the assumptions and inputs used and whether there were significant unobservable inputs or not. So again, in these situations, we would very much recommend documentation of all models and inputs that are used. Conducting independent validations, that's maybe performing another sense check using another model, comparing yourself to the counterparty's valuation, and also including training for anyone involved in these kind of models, making sure they are well equipped to deal with and understand any assumptions and inputs used in. Lastly, then, is kind of a summary of a lot of the recommendations we made on the previous slides, and it's a very important one, which is having a robust internal policy. So yeah, like we've mentioned, there could be kind of family approaches, there could be maybe inconsistent classifications. We would recommend having a risk management policy that really documents exactly what classifies anything to be in level 1, level 2, or in level 3. For example, here we've mentioned like a lightly traded corporate bond could be based as level 2, based on pricing vendor data, but it could be subjective. There could be a lot of trades around the measurement date for this kind of position. It could qualify as level 1. It could maybe in a year's time be moved to level 2, and being able to justify why you are saying this is level 1 or why you're saying this is level 2, whether you're saying I believe there's an active market because, or I believe there were significant unobservable inputs because, is very important in our opinion. And our insights here again would be to develop standardized policies for value hierarchy, have a strong governance policy in place that, again, analyze markets and trends so that any thresholds being used are in line with current market activity, and again, to provide regular training and for any updates to these kind of procedures. And so with that, I will pass you back to my colleague Nee to give our insights.
Thanks very much. So before we wrap up, I'd like to just move on to the next slide and briefly highlight on how KPMG supports clients in enhancing the accuracy and defensibility of their fair value hierarchy classifications. So the core of our approach is a comprehensive review of valuation methodologies. We assess whether the techniques used are consistent with IFRS 13 and aligned with industry best practices. This helps identify any gaps or inconsistencies early in the process. We also conduct independent fair value hierarchy assessments, leveraging both proprietary and third-party data. This includes evaluating key indicators like trading volume, bid-ask spreads, standard deviations, etc., to determine the appropriate level classification. Another key area is ongoing monitoring and regulatory alignment. Markets evolve, and so do regulatory expectations. We help clients stay ahead by tracking changes in asset characteristics and ensuring that valuation practices remain current and compliant. Finally, we use data-driven insights to enhance pricing accuracy and streamline processes. Our goal is not just to validate classifications for our clients, but also to help firms build more robust, transparent, and scalable valuation frameworks. And with that, I will hand it back to Fran to conclude today's webinar.
So, thank you so much, Ni and Andy. As you can notice, fair value hierarchy is a complex topic, and always I like to put this example to emphasize why it's important to classify correctly between level 1, level 2, and level 3. You can have, for example, Apple share price. So everyone knows that if you go to a listed and you go even to Google and you search for that, you're going to have a share price and they are going to have huge volume. So there is no discussion that is a level 1 instrument. If you are looking at an investor and Warren Buffett, probably they are going to have the proper models and they are going to have a different share price based on that is based on discount cash flows, discount multiples, and all that kind of thing. That price, in the way that is valued, is going to be considered as level 3. Now, as you can see, depending on how you are pricing your instrument and depending on the inputs that you are using, you're going to be able to classify as level 1 or level 3 or level 2. And that is the important piece where the classification is important. Obviously, under IFRS, and this is why it's important, and valuers, as us, obviously, you are in that classification all the time, you have to use the most observable input. So even if you think that you are smarter than the market and you have a model that is great, and that model is the best price that you can get, if that is considering an unobservable data in order to prepare that, so Warren Buffett with the share price of Apple, you shouldn't use that price for financial statement. You should use the most observable price. So that means the level 1 on this case. Now, all the rest is there are gray areas. It's important to have judgment and it's important to review the different ones. So with that, we are going to go through the questions that we have on the chat. We will answer. So Ni and Andy, feel free. So I will make sure that we'll review the different ones. So Andy, what factors typically drive discrepancies between KPMG independence classification and those reported by the clients?
Yeah, thanks, Fran. I think I will take that one. So in our experience, discrepancies usually stem from 2 key areas. So first of all is the availability and selection of pricing vendors. So we currently utilize 5-6 different vendors, while many of our clients rely on less data providers. And the availability of vendor quotes can vary significantly across instruments. Some of the entities may use even just a single vendor, especially for securities like loans, where number of available quotes can lead to leveling differences. Even with the same vendor, there might be various sources, like do I use evaluated pricing? Do I use composite pricing? Especially like for less liquid instruments, these may cause classification differences as well. And the second thing here would be the methodology and parameters considered. So even when using similar or exact same data, the way it's interpreted can differ. For example, we look at bid-ask spreads and trading volumes. The thresholds we apply might be considered strict by other entities. Larger discrepancies may occur when other entities consider alternative parameters or only apply qualitative methods. Overall, we suggest a combination of quantitative and qualitative structure when reviewing fair value hierarchy, which is, we understand this is not really adopted by everyone. So yeah, I hope that answers the question.
Thanks, Ni. The second question is cross securities with a stale price and get changed at month end, very less, I suppose, very low volume on month end price, can this be marked as level 1? Me?
I think it really depends on, first of all, like they need to understand like why would there be a change in price as of the month end, and when less volume is mentioned, what quantifies as, you know, active trading, and what is less volume considered by the entity. So I think setting a threshold here would be quite important. Overall, if this appears for us, I would say further analysis, like say certain manual assessments would need to be done before we conclude, but this is leaning more towards level 2 than level 1, if I'm being honest.
Okay, so another question is, when using the bid-ask spread or volume as an indicator for leveling, should you consider it over a period of time or as the reporting date? I will answer this one. So fair value hierarchy change over time. So you can have today a price that is based on level 1 input, and in 1 week later that is based on level 2 because the market has dried down. So effectively, if you are asking exactly what it should be, you have to ask always that is the reporting date, and that is the valuation that you are going to look at. How you have priced that. Said that, the bid-ask spread test that we are doing normally is because obviously in bonds it's really difficult sometimes to get actual volumes on those ones. So effectively, what you are going to have for the different houses, so probably when you go, you are going to have or Bloomberg or ICE, that is the most common ones that is in the market. You are going to go and effectively they are going to give you no volume and they are going to give you a price. What is the thing? That if you see the bid-ask spread, and that is the consideration that we are making, and that is a judgment, and that is why it's important to have the judgment in place. When we are looking on that particular bid-ask spread, we are looking if there are some liquidity, and effectively what is happening is that the market is liquid and is not based on comparables. And even if it's based on comparable, that is the minimum that we can have on those ones. The next question is, will materiality on portfolio be considered? That is easy.
Yeah, of course, like it would be considered. Like it's like, I mean, for all of our clients, this is actually a key thing for us to include in the report. And this is like, I think one of the key things where, say, if we're comparing our classifications against clients' classifications, this is the reason why we're getting challenges and queries. So yes.
Okay. Yeah, that's perfect. So just to honor our word and make sure that the training is just under 30 minutes, so everyone can go to their live. We will stop to answer questions, but I think that there are some questions that has not been answered. So I think that there are 5-6 questions that has not been answered yet. We will answer individually, make sure on that kind of things. And obviously, if any of you have any questions, just drop us an email, and we will make the slides available, as Andy was saying on the webinar, in the next week or during the next week. So first of all, thank you so much, Nia and Andy, for the participation. Thank you all of you for attending the training, and thank you for participating. Thank you so much.
Thank you.
Thanks a lot, everyone.